What is happening to YouTube and Facebook? My name is Matt Faircloth. My company is called the DeRosa Group, and this is our Mentorship Monday program. If you guys want to be a part of the Mentorship Monday program, all you got to do is get out your computer, your cell phone, your whatever it is, and send us an email to helpme@DeRosaGroup.com. That is helpme@DeRosaGroup.com. It's right here in the bottom of the screen. I cannot do this alone. I got myself an awesome co-host here to help me out here. Justin, come on in, everybody. This is Justin Fraser.
Hello, everybody.
Justin, welcome. How are you today? Who we got first guest?
Oumarou, how are you?
I'm doing wonderful. Thank you.
Thanks for joining us today.
Thank you.
I'm happy to be here.
Thank you for your question to help me at DeRosaGroup.com. What can we do for you today?
Well, I started real estate about 2 years ago, and I started reading books and I acquired my own first small multifamily, which I closed on last November. And
Congratulations!
Thank you. And I'm doing a house icon. So my question was, I started looking for another property, which is it led me to Philadelphia, which is where the cash flow would seem much better than New York City.
Yeah.
So some people was telling me that I'm moving too fast. Why not just wait? You just close this one, take your time. And I just wanted to know, ask you the question if it's something that, am I moving too fast, or should I just chill a little bit and just see what happened,
I don't think that you're moving too fast, because there's learns and bumps, and as long as you don't expect it to all be smooth sailing, I think that it's as long as you're expecting a few different curveballs. Which, number one, I know you live in Brooklyn, just north of Manhattan, right? No, you live in the Bronx.
Bronx, yeah.
The Bronx, okay, just north of Manhattan. Now, if you invest in Philadelphia, you're adding more to your plate, right? You're now investing remote instead of investing where your tenant lives upstairs, and like you do in a house hack where you live in a duplex, your tenant's right there, real easy to collect rent. They can't sneak around you too much because you live right downstairs, right? And for collecting rents. Now, if you invest in Philadelphia, you got a whole different ball of wax, because it's like a hour and a half, 2 hour ride to get down to Philadelphia. You can't do that every time you need to talk to your tenant. You've got to have really solid property management. You got to have really solid construction and rehab protocol in that. So I think that it really has to do with what systems you put in place and how you're going to position yourself financially for the deal. So tell me real quick, how are you going to finance the deal? And tell me what systems you plan to use to run a deal in Philly while you're up in the Bronx.
Well, right now I already have a team in place. I have a property management that I'm working with, and I also have a real estate agent that I'm working with that's sending deals.
There you go.
Yeah, I already have my loan officer that I'm working with. I'm just raising money through friends and family for the down payment.
Yeah.
And, I'm looking to see, something that once I get the deal, I could either give them, the investment wise, I give them 80% and probably keep the 20%, and something like that. I'm looking to.
That's a lot.
Yeah.
That's too much.
Just starting, because I'm trying to not put my own money in. I'm just
No, I get that. But how big of a deal are you going to do? How big of a deal are we talking about? Like a duplex or like something a little bigger, or what?
Yeah, we're looking like a duplex, like 3 family, up to 4 family I'm looking for.
Yeah. Okay. If you go giving away 80% of the deal to a private to like your private investors, you're not even going to make $100 a month. They just given what the market is down there and everything like that. And I'm not trying to bust your bubble. I'm just trying to take care of you. What I have found is the bigger the deal is, the more you have to give away to investors. So Justin and I are buying a hopefully, knock on wood, we're buying a 336 unit in North Carolina. If that Justin, come on now. I forgot to. I should say, come on in. Right.
Put myself back in.
No problem. So we're buying a big deal like that. We're doing an 80-20 split on a big apartment building like that, right? My first deal that I did, I bought a single family home. I bought 2 single family homes. My first private money deal. I own the one next. Me and a partner owned. We bought 2 properties. We did a 50-50 split, right? Because there's more work you have to put in for organizing the deal, structuring it, and everything like that. So my 2 cents, Oumarou, is doing a little more favorable your way, because you're going to have to do a lot to earn that money. So if they put up all the money, just consider 50-50. That's my 2 cents. Justin, what do you got?
I would run the numbers with debt as well. So take it as a private loan. There's nothing that says you can't do 100% of the purchase and whatever renovation you're going to put in as a private loan. And if you're buying it right and maybe you're borrowing this thing, then you'd be able to refinance them and pay them at least partial of their money back and reduce that loan balance. So even if you're paying, 7, 8%, whatever you have to pay, that might work out better than giving away half or 80% or more. Yeah, you're right. But certainly better than giving away 80% of the deal.
What do you think, Oumarou?
No, I was just thinking because, it's the first time out of state. I'm just trying to get my feet worked. And so I don't mind giving away more of the deal just to get started. Once I get the second, third one, then, I could delegate, I could manage how percentage I'm going to get. But it's just the first deal that I was just trying to give away. So I could also learn from it, yeah.
Here's my 2 cents on that. Go ahead, Justin. You go first.
I was going to say, do you have investors lined up that are asking you for 80% of this deal, or is this just a number that you're thinking you're going to need to entice them?
Well, I have friends and family that are willing to, loan me the money. I'm the one that just want to give them more of the deal because, they trust me enough to hand me the money.
You want to do right by them. I get that.
Exactly, yeah. So that's
run the numbers on what kind of return they're going to get at 80%. Okay. Number 2, if you establish the precedent of giving 80% to these folks now, it's very hard to go down. Okay. It's much easier to go up. Like, again, I started at 50-50 and I've had to give away more and more the larger deals that we've done in that. So I would recommend that you start at more for yourself and then slowly give more away as they become repeat investors and everything like that. And also, I'm saying this with love, okay? Don't discount what you bring to the table. I heard you say something that I wanted to make sure I address here, that you want to give them more because they're trusting you and give them more because you want to take care of them and everything like that. That's good. And that's very altruistic of you and everything like that. But number 1, you got to take care of yourself too, right? And make sure that you get covered in this thing. In that, because I don't want to see you get frustrated and not make enough to cover your own overhead too. Right. This is, a good conversation. Just talking about how much equity to give investors is a really good conversation. And I think that it's valid. And I just don't want to see you give away more than you have to. A lot of this is in my book, in Raising Private Capital. I hope you pick up a copy of it because that book gets into a lot of the details and nuts and bolts. And as Justin said, also consider just having them loan you the money at a high interest rate, even higher than 7 or 8, maybe 10.
Sure. Whatever it takes to get the deal
flat
done.
Interest. Yeah.
I will say I love that you are thinking in the long term and you're thinking, okay, I want to get a deal done in this new market using private money, and then there will be more that'll be more lucrative. I think that's a great approach. But to Matt's point, you also don't want to short sight yourself. If you're only taking 20%, that may not cover you traveling down to the property once a month, depending on how well you're cash flowing. So you got to make sure that you're incentivized as well to run that project. Otherwise, that's putting their money at risk too.
Oumarou, thank you. I hope that was a value. Either way, I think that you've got your money lined up. It sounds like you've got your team lined up. I think that you should think a little bit more about systems and process and like deep stuff you might not have thought about, like how you're going to run the books. And accounting and making sure that the dollars and cents add up and stuff like that. That tends to show up as you start owning more and more rentals. Financial systems are going to start to become more and more important. So that's my other tip for you. But I think you're on the right track, and I hope this is helpful. Thank you for joining us at helpme@DeRosaGroup.com for Mentorship Monday, man.
Next up, Mr. Ryan Daigle. Hey, Ryan.
What's up, Ryan?
Hey, doing well.
Doing good, man. What can we do for you today?
All right, so a little context. So I have a 16 unit with my co-GPs in Fayetteville, an area that you're familiar with. I also have a 12 unit in Mebane, which is a town that's about 30 minutes from Greensboro, 30 minutes from Raleigh-Durham. So I've been transacting in kind of these smaller multifamily sizes. My next step is to kind of move in the 20 to 30 unit range and get something a little bigger under my belt. The issue I'm having is that my current approach to get that next deal in hand has been to work through brokers. So lots of broker relationships, obviously some a little more active than others. What I'm finding is, though, that anything that's kind of marketed with an OM and is coming through the broker network, when I pass it through my underwriting, the numbers just rarely work out. Quite often just don't even come close, right? These things are just so wrung out by the time they come through the broker network that nothing is left on the bone for me to get. So I guess my question is, How are you? What does your acquisition strategy look like? You're prospecting to find decent deal flow, and is it just a numbers game, or should I be have a little more nuance in my approach rather than just solely relying on brokers?
Good stuff, man. So we've done the deals that I've done in that size. Like Justin owns a 40 unit that I partner with him on. I own a 49 unit, 10 unit in that, and I bought and sold an 18 unit. And everything in that price range, in that size range, was brought to us by brokers. And so I think that brokers are likely the necessary evil in that space. It just is what it is. I think that the good news I have for you is I think that there's going to be a correction in that size real estate, because almost all that size real estate is mom and pop owned, and COVID is likely kicking their butt, and everything like that. So I think that you're in the right frame for growth. But I would say that just a couple questions. You said that the deals don't really make financial sense. Are you sure that you're getting first look at these deals when they come out?
I would say, given that I'm not somebody who's done millions of dollars worth of transactions, I'm most certainly not getting a first look at these deals.
Okay. Are they setting, do you think that they're just kind of shopping it around and then you're just kind of on the shopping list down the list? Or because if you're getting the scraps or the stuff that's already been picked over, then that's a concern. And then your task is to get the brokers to take you seriously. Are you making offers on the stuff that they do send you?
Only when it's close enough that it's not an insulting offer. So I check first, but then yes. Yeah,
I would have you called them and say, hey, listen, I see you're at 1.5. Best I can do is 900,000. What do you think?
Yes.
You'll call them and they'll say, don't even write up an LOI.
Yep.
Okay. All right. I think that it's a matter of looking at your underwriting too. Do you have any idea what your typical income to expense ratio is? Sorry, I'm going micro now, but maybe you're evaluating yourself out of the deal.
I think that's likely, right? I like to be a little more on the conservative side, but if you're conservative across the board, especially in some of these high leverage inputs, then you're never gonna find something that works, right? So my expense ratios, low as I'll go, is probably 45, 43, if it's got a proven history and is an asset class or a type of property with a tenant base that I think that can support that. One thing I do that I've started to pull back on already is I used to be really conservative on what that exit cap looked like. And I've kind of changed my thinking a little bit to, instead of thinking about, okay, this is a 5 to 7 year hold, and so I want to be conservative, what I think I can exit at 5 to 7, I'll add 15 bips a year for every year of my hold to get that exit cap. Instead of treating that 5 to 7 year hold as like a single endpoint, I spoke to somebody recently who kind of changed my thinking, which is to think of it as a 5 to 7 year period with which you have to hit your preferred exit cap rate, right? So there's a little bit of a mind shift there, that it's not just purely going super conservative. You can be a little more nuanced in what you think your exit point's going to be. So that's
you're being too heavy on cap rate on the size deals you're looking at. I wouldn't put too much focus on cap rate. What I would focus on is, and you're going to raise capital for this, right?
Yes.
Okay. I would focus on just investor return, so IRR, that kind of thing, because cap rate's going to move all over the place the next couple of years.
How do you get your final IRR if you don't know your exit cap? Like, what are you going to base your exit price on, which will obviously be a big part of that return?
Yeah, it's a good point. Okay, I'll give you that. That's right. I think that we're also looking at bigger deals.
I can address that in that we've been moving to more valuing the cash flow that the property is producing over time. For a while, a lot of deals were like, okay, you might make like 4, 5, 6%, and then have a big boatload of money at the end. The way that we're structuring our deals lately is more emphasis on the cash flow each year, less on that big payday at the end. So we're not stretching, what we think we're going to be able to get as far as a sale price when we're modeling it out. It's more about, use the average cap. You still have to obviously use the cap rate, and you want to be, a little conservative there. I get that, but it's more about how is this deal performing year over year than this big payday and 10 years based on a bunch of assumptions.
Does that only work though for your C class and some of the types of properties that have higher cash flow, right? Like the higher you go up in your classes, like B class or A class, you're necessarily going to be reducing your cash flow because it's just a more conservative, less risky type of asset, right?
Well, it just depends on the investor base that you have, right? So if your investor base is willing to take a 2% cash on cash return, but you're in a great area, A plus, whatever, where there's low risk. Great. if they want to be in C class and they're more comfortable with that 8% return, then that works too. It just depends on what type of deal you're bringing to your investor base.
What kind of return are you trying to make these investors?
They don't have to. They're not the most aggressive, so they have conservative expectations, and as long as the asset is appropriately, the risk reward is appropriate there. So anything 10 to 12% that I can get as far as IRR, so not cash flow, it's total return. If cash flow is close to 6% and double for the IRR, but it's not, it's a mostly stabilized B class asset. That's something that's within their target range.
Okay, try this. Try on this model the next time you get a deal. And this was given to me by a friend of mine that's made a ton of money in multifamily. You put a cap on the investor return, but let's just say you tell them, okay, listen, I'm going to give you an 8% preferred return on the deal. So that means you put in 100,000, you're going to make 8,000 a year. Or the deal is going to owe that to you, or it's going to pay it to you on a monthly basis. Okay. And then when I go sell, when I go do whatever I'm going to do, you are capped at 12% return on your money total on your time in the deal. And so what that does for you is really quoting investors more on cash flow, what they can expect with a little bit of a bonus on the back end. If you look for deals that make sense somewhat financially, and if you figure low debt, because debt's somewhere in the 3.5% to 4.5% range these days, you could likely slip into Fannie or Freddie small balance on a 20 to 30 unit deal. We just got quoted a Freddie Mac loan at 2.9% in that. So you figure that super low cost of debt, you probably can meet a pref hurdle at maybe 6, 7, or 8, somewhere in there. If you tell that investor, I'm going to pay you between 6 and 8%, whatever number you can think the deal can make, and then a little slice for you on top, I'm going to pay you between 6 and 8%. And it's going to be, secure. It's going to be regular. It's going to be a check once a month in the mail. And as long as the deal makes enough money to pay that pref, I'm going to pay it to you, and you can set your watch by it. And then when I sell in the future, you're going to get a check too, and it's going to be a chunk of the upsale, and it's going to be capped at 12%. So that's the most you're going to make, but at least you'll be making either 6 on a monthly basis, or you'll make a nice check to get you up to 12. So it's predictable. Now the benefit to you is, as long as the deal can outperform that 6 pref or 7 pref or 8 pref during your time of ownership, all the extra money goes to you. And then when you sell, as long as you can meet a 12% hurdle on the back end, all the extra money goes to you too. And if you can't meet that, then you just keep on cash flowing it. It sounds like your investors aren't that picky.
The ones that I'm working with now are looking to get experience and kind of, peek behind the curtain to how these things work. So part of what they're, wanting to buy into is an educational experience for them as well. So have adjusted their expectations.
I call it earn while you learn.
There you go.
Earn while you learn, right?
I want to go back to the beginning part of the question, I think, which is also broker relations.
Yes.
Because if you're just getting, the same email blast that, everyone else is getting, first off, is that the case? Or are you getting like some emails from brokers saying, hey, we're going to send this out next week. Here's a little preview. There's
one broker I'm working with that I can definitely say we've got a much more active relationship, and I feel like I'm getting, getting some inside deals or some heads up there. Most of the rest, though, are certainly, I'm just a name on a list for them.
Right. So we want to get you off the name off on the list and more into the personal relationship category as well, which you've already done with one, and you're going to want to do with others. And so if you see some of these brokers are putting up deals in the area that you like, where you're saying, my number just doesn't work, those are the guys you probably want to go the next level for relationship building, meaning you're touring their properties, you're taking them out for dinner or drinks or whatever, and just more FaceTime, right? The more FaceTime you have, the more they know that you're serious. If I put up 10 deals and you come look at every one of my 10 deals over the last year, I know you're serious. I know it just hasn't been the right deal yet, right?
So I hear that. My hesitation with that has always been, am I going to look like just a tire kicker if I show up 10 out of 10 times and I never do anything with you, never do a deal? Do you feel like brokers will value the effort and the interaction and will not knock me for the not executing yet?
No, if you go look at it, if you run their numbers, if you send them your underwriting and have them tear your underwriting apart, because they'll tell you, hey, listen, you really overvalued the property management expense, whatever it is. they'll look at your numbers with you. And if you always look at their deal and always take their deal seriously, because these guys can't control sometimes what they're selling. Sometimes they know they're shopping a pig around, and they know it's an awful deal that's probably overpriced and some greedy seller wants too much money for their property, but they're hoping somebody will at least take a look at it for them. And it may just, this isn't a hobby for them either. Like they don't make money until the property sells. So if you take them seriously, I have found that they will return the favor. So, so I would look at every deal they send, give them feedback on every deal they send. Check if they don't send you deals in a couple of weeks, call them, check in. Hey, Joe or Jane, just calling to say hi. I haven't seen anything in a little bit, anything cooking, just calling to say hello, no pressure, So that's, and additionally, I would continue to shop for new brokers because you may not be talking to the specific players in the markets that you want to be in. Maybe there's other players you don't know about. I don't know who you're talking to, but there may be players in those markets.
So on the broker front, one thing that I haven't quite figured out how to navigate is, say you have a brokerage shop, Marcus and Millichap, just as an example.
Yep.
You have a relationship with a broker at Marcus and Millichap. There are kind of silos within these brokerages, right? So just because I have a relationship with one M&M broker does not mean I'm getting inside access to the whole universe of.
It's very true in that organization. That's extremely true.
So, do you make sure that you are reaching out to each of those silos within these bigger brokerage shops?
For that company, yes. For other companies, they do more of a collaborative commission, meaning like if this property sells over here and they form this gargantuan team of brokers that are all helping move that deal down the field, they may share in a big chunk of commission. So at Marcus and Millichap and a lot of the other organizations out there that are like them, you eat what you kill. And if you don't kill anything, you don't eat. At other organizations like Cushman and Wakefield, they all kind of like share in the kills that they all do, right? There's a collaboration that happens in that organization. Now, there are benefits to working with both those guys. Marcus and Millichap guys are hungry and they will run to find you a deal if you do something. Cushman and Wakefield collaborates, and there's other ones out there too. There's Waterstone and other organizations. It helps to understand how they're structured and how they're. I mean, you got to find this out with kid gloves. You can't just ask them straight up like, "Hey, how are you paid?" and that. But you want to ask, "Are you guys on like a collaboration model? Are you guys on just like more of a, you kind of operate?" And a Marcus and Millichap guy really is in business for himself. Like he's like an entrepreneur. They can do whatever they want. With under the real estate brokerage guidelines, but they really kind of carve their own path. So, Justin, what are your thoughts on that?
Yeah, and I think the key is to provide that feedback, and not every deal is going to work for your investors, and that's ultimately like you are the conduit of your investors when you're looking for a deal. And so, if you tell the broker over and over, this doesn't work because of this or that, they'll start to get a sense, and some will, they're probably not going to want to work with you. That's fine. But the ones that recognize the effort that you're putting in, those will be the ones that'll bring you deal after deal. And you're in Raleigh, right?
Yep.
Yeah. So there's a lot of people up here in New Jersey area that wish they were in Raleigh because they want to be investing down there and they want to be going and meeting those brokers and all that. I did that when I started. I drove to Virginia like all the time, right? I was taking vacation days and everything to go meet with brokers. So the fact that you're already there gives you a leg up on people that are trying to come in from Jersey or somewhere else. So go, just get FaceTime with them and give them real feedback and consider their offering and give them constructive feedback on why it doesn't work.
Mm-hmm.
Yep. And you'll get it.
Matt, you said something up front that surprised me when we were talking about we're talking about the smaller deals, like the 20 to 50 size deals, that when you were doing those types of deals, you got all of them through a broker. That surprised me because I thought the opposite was true, which is the bigger boy deals, 100 plus, that's completely owned by the broker networks. The smaller deals are the ones where you have more success going direct to seller and things like that. So
let's talk about that. Let's talk about direct to seller briefly. We've done very little of that because it takes there's a lot of farming, a lot of fishing you have to do, a lot of mailing campaigns. There's only but so many hours in the day, right? Additionally, I've talked to people that have done that. What I just talked about, that they've gone and door knocked, they've gone and found tired owners or found apartment buildings that are dilapidated that need a lot of injection of capital or whatever, need to get brought up to the next level. found the owner, cold called him. Hey man, you should sell. I want to buy. And then they got the owner right there. And then the owner's wife or their brother-in-law, whatever, got in their head, and they went and called Marcus and Millichap, and that. So all I'm saying is that you're not in control of the deal until you're under contract. And a lot of times, unless they're under severe distress and you can offer them something that nobody else can, then you're no different than a broker. And why would they give it to you? So you've got to address that question. I can tell you the why would they give it to you is like, hey, listen, I can give you a quick sale. I can give you no hassle. I shot a video. We'll see if we can remember to post it here, but there's a video on my YouTube channel called Tired Owners. So if you watch that video, I give 3 different equations on how you can find a tired owner and how you can buy and negotiate a deal brokerless on a tired owner. Because they're going to ask the question, why would I sell to you? Why can't I just go and call, Joe or Jane from the brokerage down the street and have them list my property? That video has some comebacks and some ways that you can structure and also ways that you find these folks. So we've done very little of it, but I've also learned a lot from people like Sterling White, who's a friend of mine and a Bigger Pockets contributor, who's done a lot of, I think he's got almost 1,000 units and it's all been direct owner. So there's an equation, there's a secret sauce.
It's just not the approach you've taken. And you kind of have to look at where your skills are, what time you have, how willing are you. A lot of these direct to seller efforts too, they require, you can't just do it 1 month. You've got to do it 1 month, 12 months before you see anything.
And you have to be willing to get your heart broke too, to have an owner of a deal that's perfect for you, to have them get right to the table and to write about to ink a deal and say, I think I'm going to call a broker, and I'll make sure you're on the bidders list. It's like, well, thanks.
You did all the legwork.
Yeah. So,
okay. I appreciate that.
Another good episode, man.
Good stuff. And again, lots of great questions, great
interaction with everyone. And
I love it. A lot of familiar names, familiar faces on here. So good stuff. Well, hey, Justin, thank you. Always a pleasure to be here with you on Mentorship Monday. Look forward to seeing you out on Insiders and out in the field, man.
Hope you have a great and
profitable week.